Let's be honest, one of the first things all of us dividend investors look at is the yield. We try to fight it, we try to deny it, but the higher the yield, the more tempting the stock becomes. With that said, a dividend yield that looks too good to be true tends to come with more of a story. And right now, the situation with UPS, which is a company that needs no introduction, is definitely a story worth telling. Taking a look at the share price performance over here using Snapstock, which you can start using right now for your own stock research and analysis. There's a link to Snapstock in the description of the video and in the pinned comment. But UPS here has had a really tough year. We can see that so far year to date, the share price is down about 30%. Looking at the performance over the last 365 days, it's down about the same. And even zooming out over a longer period of time, over the last 5 years, the stock is still down 35%. That is incredibly poor performance. There's no doubt about that. And the thing about the share price going down is that it has pushed the dividend yield way up to 7.72%, a pretty ridiculous yield, which is more than double the company's 5-year average yield of 3.3%. Now, typically when a stock's dividend yield moves up above the historical average, it makes the stock look like a bargain since dividend yields tend to hover within a certain historical range. This is based on something called the dividend yield theory, which says that if the stock's current yield is far enough above its historical average, like in the case of UPS here, then the stock is likely undervalued. And on the other hand, if its yield is beneath the historical average, like in the case of Microsoft here, then the stock could be overvalued. Now, since UPS is currently yielding like 2.5 times what it normally does, the real question here is whether this is a golden buying opportunity for dividend investors or a warning sign that something is wrong with the company. That's really what we're trying to uncover here today. Now, UPS is one of those companies we all interact with, probably some more regularly than others. The company delivers millions of packages every day, which undoubtedly makes it an essential part of global commerce. What makes a company like UPS tough to compete with is the combination of its global scale, distribution network, and unmistakable brand. You can't just wake up one day and build out the fully functioning network of planes, trucks, warehouses, delivery routes, and technology that UPS has spent over 100 years putting together. The company was founded in 1907, so it's been around a long time. Getting into some of the financials, the problem here is that after hitting record highs in 2021 and 2022, when sales, earnings, and free cash flow were at all-time highs, UPS has taken an undeniable step backward. As we can see from the charts here, earnings per share and free cash flow per share in particular have been moving in the wrong direction, which is a big red flag for us dividend investors. Lower earnings and free cash flow mean there's less funds available to pay for the dividend, which can call into question the safety of the dividend. Fortunately, the company is still generating plenty of revenue. For the most part, it looks like the revenue growth has actually been pretty consistent, but it hasn't been able to turn that into consistent bottom line growth. One of the biggest reasons for that is higher labor costs. In 2023, UPS signed a new labor contract with the Teamsters Union, which secured major pay increases and benefits for roughly 340,000 of their employees. While that was a big win for workers, it also puts a heavier financial burden on the company moving forward. Another detriment to the financials is declining package volumes. As we can see from the graphic here, domestic demand has been trending down over the last few years. Slightly, but you can see a downward trend, and UPS isn't the only company feeling the impact. Other shipping and logistics companies like Old Dominion Freight Line and FedEx have also reported weaker shipping volumes, and their share prices have also taken a pretty big hit. Looking at Old Dominion share price performance, year to date, it's seen a really big drop, down 16%, albeit this is about half of the drop that UPS has seen, but still pretty deep down in the red there, and over the last year, the stock is down almost 21%, so another big drop here. And then looking at FedEx, we see a 17.5% drop year to date, so another very big drop for those guys, and over the last year, the stock is down about 20%, so pretty similar to what we saw with Old Dominion. With all of that said, it suggests that the slowdown isn't entirely UPS's fault. I mean, some of the blame can be passed on the broader economy, which does make sense. This is a cyclical business that depends on how much stuff people are buying. Now, in addition to declining earnings and free cash flow, there are some other cracks starting to show, like in the debt department here. First and foremost, we do see that the company is consistently increasing their debt. It's actually gone up quite a bit over the last decade, and it's grown on average by about 6% over the last 10 years. With that said, though, I will say the net debt to free cash flow still looks to be in really good shape. Despite the increase in debt, The net debt to free cash flow is still only about 3.9, which is below where I'd like to see it for a company like this. My threshold is about 5, so 3.9 is obviously below that, so it's still in decent shape. The big issue, though, out of all three of these charts is the interest coverage ratio. Back in 2021, UPS could cover its interest by about 25 times over. Today, just over these last few years, that has dramatically fallen to just about 7.5, slightly below where I'd like to see it. My threshold for the interest coverage ratio is about 8, so 7.5 isn't terrible. It is below that number, and I would say that more than anything, the concerning thing about the interest coverage is the trend. It is really, really declining, and if it continues, it's going to get to a point where it becomes much more problematic than it is today. And I think the dividend tells a similar story. Obviously, this 7.7% yield is undoubtedly hard to ignore, but if we scroll down, these payout ratios are looking a bit too questionable for my liking. Starting here with the earnings payout ratio, in 2021, the company was paying out about 27% of their earnings to the dividend. And over here, looking at the free cash flow payout ratio, in the same year, it was about 33% of their free cash flow going to the dividend. So plenty of coverage in both departments. And granted, the company was generating peak profits during this time, so it makes sense that we would see the payout ratios a bit lower, but still plenty of wiggle room for the dividend. And fast forward to today, looking at the free cash flow payout ratio, in the trailing 12 months, they're paying out 158% of their free cash flow to the dividend. Looking at the earnings payout ratio, it's almost 100%. Either way, it's definitely not sustainable. And part of the reason that these payout ratios shot up so much is because of the declining earnings and free cash flow. But I will say, if we scroll up looking at the dividend growth chart, it did not help that in 2022, UPS raised the dividend by almost 50%. Now, once again, these were peak profit years, so they were likely riding high off of that, but now the fundamentals haven't kept up, and that's exactly why I'm so concerned that the company may have no other option than to cut the dividend. We see that the dividend growth here has really slowed down. All in all, I don't personally own any shares of UPS, and at this point, I really don't have much of an interest in doing so. I think the financials are heading in the opposite direction of where I'd like to see them, and the dividend coverage, or lack thereof, is a major red flag for me. Now, with that said, it's not all bad for UPS. I mean, the overall snap score is still pretty high at about 6.5, and we can see it's still scoring well in most categories here. But if I wanted exposure to a shipping and logistics company, I would much rather look at a company like Old Dominion. As we can see, their snap score is much higher than UPS at about 7.7, and they're getting really strong scores from top to bottom here. And even though the dividend yield isn't nearly as high as what you'd get from UPS, it's actually about a tenth of UPS's yield right now, the dividend growth rate is absolutely phenomenal. About 36% on average over the last 5 years, and just look at that chart. This is a real work of art. And based on the much lower payout ratios here, it looks like 21% for the earnings payout ratio in the trailing 12 months. It looks like about 25% for the free cash flow payout ratio. I think Old Dominion's dividend has a much better chance of continuing to grow as time goes on. Plus, if we scroll up looking at their debt situation, they have more cash on their balance sheet than they do debt, which is a major green flag for me. I love to see this. And continuing on up, looking at the profitability, Old Dominion is actually increasing their margins over time. The net profit margin has gone from about 10% in 2015 to double that in the most recent year. And the free cash flow margin has really skyrocketed, going from about 3.1% in 2015 to now 15.25% in 2024. That's very impressive. So overall, I think this company is looking a lot better under the hood than what we're seeing with UPS. I really hope UPS doesn't end up cutting their dividend, but based on everything we just looked at, it also wouldn't surprise me to see them do so. And that's the thing, you've got to know how to spot these warning signs before it's too late. If you want to see the 5 biggest red flags that tell you a dividend stock is actually a bad investment, then check out this next video right over here. In this one, I'm showing you exactly what to watch out for so you don't get stuck holding onto the wrong stock. This is a really important video, so click right over here to check it out, and I'll see you in the next one.